Welcome. I'm Nic Spicer, UK Head of Investments here at Portfolio Metrics. And we're going to be doing a quick run through of our recent white paper, ESG in Investing, Everything You Wanted to Know But Were Afraid to Ask. The ESG, of course, standing for Environmental, Social, and Governance, the latest way of looking at portfolios that are actually designed for an additional purpose beyond just achieving financial returns. So the white paper really tries to break down all of the key elements of this type of investing and address some of the sort of key issues that advisors have when they are speaking to clients about these. Some of the key issues like terminology, some of the key issues like performance. Is there a conflict between doing well and doing good in these portfolios? And do I have to sacrifice some returns when I am actually sort of investing responsibly and for people and the planet? It also looks at a history of ESG investing, as well as some other sort of key areas of what are the characteristics of the underlying portfolio. So let's just run through a couple of those sort of key areas now. So what we've really tried to do in this white paper is we've tried to bring all of that together and sort of break down these terms in a sort of jargon-free way. And I think probably the most helpful recent effort here, which we've borrowed from quite heavily in this paper, is a paper from the Investment Association here in the UK, where they're really trying to create this coherent framework for investing or talking about responsible investment. And probably the first thing that they actually came up with is what is the right umbrella term. So a lot of the time, there's been terms bandied around like ESG investing or socially responsible investment, SRI, ethical investing, green investing. But the term that they really settled on as being appropriate to encompass everything, the umbrella term for all of this type of investment was responsible investment, trying to incorporate everything where there is a sort of a second purpose to a portfolio. It's not just focused on financial returns. There is a purpose in terms of benefiting the environment, society, or actually having a consistency with sort of the underlying beliefs of the end investor. What we have here is a chart that really tries to encapsulate all of these different terms that the IA has pulled together. And you'll see that it's broken down where you have from left to right, going from least impactful in terms of social and environmental impacts. And that would be your agnostic investing. So something like a FTSE 100 tracker where you're not focused on responsible investing per se, all the way through to the most impactful you can actually be, which is really through philanthropy, where you are not actually investing at all. You are giving money away to try and have the maximum possible impact. And then somewhere in between those are all these different types of investing where you are trying to achieve a return, but you are actually also trying to have a higher purpose as well. And you can see that here also we've broken those down by the different types of financial goals that you actually have. So those types of investing socially and responsibly where you are trying to at least have competitive risk-adjusted returns, so something similar to the market or even better. And then you actually have those that are slightly more impactful, but actually will have a slightly lower return. And that would be somewhere along the impact investing side of the spectrum. So these are the different terms that, different components that the IA has actually broken the market down into. So stewardship is one of them, where you've focused on the long term. You are very client-centric. You're actually engaging a lot. You're being an active owner. ESG integration, which is where you are using the sort of framework of environmental social governance to actually look at the risks and opportunities that a company actually has. It's inherent in that particular company. And you are using that to evaluate whether to invest in a company or not. Sustainability focus, where you are actually sort of investing specifically for particular sustainability goals. Exclusions, where you're excluding companies that have these negative social or environmental effects. And then really impact investing, which is probably the most impactful of the responsible investing criteria, where you're trying to have a definite measurable impact, often actually sort of linked through to the Sustainable Development Goals, the UN Sustainable Development Goals. So that gives you a brief overview of the terminology, which we go into a lot more detail in the white paper. The next key question would actually be looking at performance. It's probably the key question that clients will actually have when they are looking at investing responsibility. They'll ask their advisors, is there a conflict between doing well in terms of my own investments, the performance, and doing good? So actually having that sort of positive impact when I'm investing. And we actually looked here in the white paper, we tried to look through the short-term numbers and concentrate really on rigorous peer-reviewed academic literature to ask this question of, does investing responsibly actually negatively impact performance? And it was quite interesting takeaway here. The takeaway was that the glass is at least half full, in the sense that there was no definitive evidence that responsible investment funds or portfolios actually underperformed over the long term. The slight fly in the ointment was that there was no definitive evidence that these types of funds and portfolios that were investing responsibly actually outperformed either. So it was sort of fairly neutral on the performance front. But that's still quite powerful. You can actually have this positive impact without actually sort of negatively impacting your performance, it seems. There were also tantalizing signs when we looked at the academic literature that certain sustainable strategies could actually add quite nice returns over time to the portfolio. So there is a potential to actually add additional returns through being sort of active and using these types of sustainable strategies. So the key takeaway we came away with when we looked through this all this research was, it seems that investors don't actually have to choose between profits and people and the planet. They can actually have both. So what else is in the white paper? Well, we focus in on a number of other sort of pertinent areas around ESG and responsible investment. So the first is a history of responsible investing. We actually look at how it's developed over time, everything from its origins in Islamic banking, where there were certain exclusions in the 7th century, through to 2004's coining of the term ESG, to the 2016 Paris Agreement. So we go through all of those different stages of the development of ESG investing. Then we look at ESG measurement and rating agencies. So there's some big players in the actual rating of how strong a company is in terms of its ESG. So the big names like MSCI, Sustainalytics, and we look at their strengths and weaknesses and what those ratings actually mean and how they should be used in terms of portfolios. We also look at the characteristics of responsible investment. So as it turns out, these types of portfolios tend to be higher quality in terms of the companies that are actually selected. Those companies tend to be slightly larger, but they also tend to be a little bit more expensive. So how does that influence the portfolios that are actually built with these types of investments? We also then focus in on some of the forthcoming regulation in the advice market. So it turns out that, particularly in Europe, regulators are really getting to grips with ESG and sustainability. And this is actually going to feed through into some very specific requirements, likely next year, that are going to be announced for advisors, particularly around the need to incorporate ESG preferences of clients into their portfolios. So there'll be a requirement within the suitability rules for advisors to actually take account of clients' ESG preferences. And the second one is really around sustainability risks and how advisors and asset managers are going to actually be required to be very clear about what these actually are and how they're taking account of them in their actual advice processes or investment processes, and likely have to put these in advance on their website so that clients can see them before actually engaging with a particular advisor. The last thing that's actually in the paper, which we think will be quite useful, is just a summary and appendix that goes into a lot of the jargon, the terms that are used in this particular field, really sort of a jargon buster to try and help advisors come up with and understand exactly what's being talked about when it comes to ESG investing, responsible investment as a whole. We've tried to put together an advanced action plan so that advisors are very well prepared. And this is some things that they can do already in terms of getting ahead of the forthcoming regulation. And so this action plan breaks this down into a couple of sort of key points. There's 5 of them. The first is really for advisors to read up on responsible investing. This is very much why we've put this particular white paper together, to try and give advisors as much of a roadmap as possible. The second is really for advisors to create a responsible advice policy and to put that on their website. So this will help them with those disclosure regulations that are coming into place. The third would be for advisors to actually add ESG questions into their risk questionnaire or client fact find, just to help them to actually find out exactly how clients feel about this type of investment, where exactly they lie across this risk, this impact spectrum, and how deeply they actually care about this particular aspect of investing, which will help you to select better investments for those clients. The fourth aspect is to know your product and service providers. So ask to see their responsible investment policies or their ESG policies. And the last is really, the fifth step in this stage is really for you advisors to document their findings. So be very clear that they have actually asked these types of questions, they have spoken to clients about these. So that's it. A quick overview of our recent white paper, ESG and investing, everything you wanted to know but were afraid to ask. We hope this video summary has been helpful for you. It's an incredibly fast-moving area, very exciting area, and certainly one where clients are starting to demand a lot more information, and advisors are starting to see additional regulation coming through that actually insisting that they start to ask these questions and have these conversations with clients. Certainly, if you want more information, please have a look at the full white paper. The details of where you can download it are actually on your screen now. And thank you very much for your attention.